So if you've been watching my videos, you know that if you're a real estate investor and you want to use a life insurance policy for real estate investing, that policy needs to be a maximum overfunded policy design. But when you get your life insurance illustration from your agent, how do you know if he's done it right? How do you know that the policy is designed to be a maximum overfunded life insurance policy? Well, in this video, I'm going to show you how to read a policy illustration. And I'm going to give you a bunch of things that you can look for to make sure that your policy is designed right. And I'm also going to show you a few agent tricks, things that agents sometimes do to make the results look a lot better than what they should be. So I'm Tom Rutkowski with Innovative Retirement Strategies. I've got to confess, I'm a bit of a financial nerd, so things like compounding interest and interest rate arbitrage fascinate me. And I discovered the concept of the double play on my own many years ago, and it's so powerful that I wanted to share it with the world. So the goal of this channel is to demystify life insurance and give you the tools that you need without ever talking to an agent to get the most efficiently designed policy possible, to maximize your wealth accumulation through your use of the double play. And the double play is putting your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. And along the way, I hope to debunk a lot of the myths that people have about life insurance. So while I am an agent, there won't be any selling on this. These videos are purely educational. So today we're going to be talking about what to look for on a policy illustration to make sure that your agent designed it properly so that it's a maximum overfunded life insurance policy. And then we'll also take a look at a few agent tricks, things that agents can do to make the results look better than they probably should be. So stick around, we'll get started. All right, so let's take care of some formalities. Nothing in this presentation constitutes financial or tax advice. And the primary reason for purchasing life insurance is for the death benefit protection. Any other benefit is ancillary. The purpose of this content is simply to show you how to do or how you can do what you were already looking for information on while you're doing your search on the internet. All right, so let's get started. So the first thing to look for is just make sure that you're looking at a full policy illustration and not just a report or summary. A life insurance illustration should be 30 to 60 pages long, and it's going to explain everything about the policy. How all the riders work, how life insurance works, how loans are done, how the interest is credited, how dividends work. So make sure you're looking at the full policy illustration. All right, one of the most important things that you should look for in a policy illustration is that the cash value to premium ratio is 85% or thereabouts. So if you're healthy, fit, non-tobacco using, you should expect about 85% cash value to premium. And this applies to both whole life and indexed universal life. All right, so on screen I've got an example of a policy illustration. I've exported the values into Excel and reformatted so that it's not exclusive to any one company or not identifiable as being any one particular company. But if you look at this, I've highlighted some cells in orange that show the cash value and the surrender value being about $92,000, where the premium was $100,000. And please don't mind the high numbers that I'm using. I'm only selecting these numbers so that we have nice big round numbers that we can use, and we can easily calculate the percentage of cash value based on that premium. So here's another illustration from last week's video that I did on policy costs. But here again, you can see that the cash value to premium ratio, shown by the orange arrow up at the top, is showing that there's about $18,392 of cash value out of a $20,000 premium. All right, so the third thing that you should look for when you're looking at an illustration is there should be something in the illustration that shows the MEC limit. It might be also called the 7-pay rule limit. And in a universal life, there's what's called the guideline level premium, GLP. So the guideline level premium is the upper limit on the definition of life insurance. So given a set death benefit, like let's just say $1 million, it shows the maximum level premium that you can put into a policy before it violates the definition of life insurance. The MEC, on the other hand, is the definition of a modified endowment contract. So that's a policy that's paid up in 7 years. Here in this example, you can see that the MEC limit is $57,000 and the guideline level premium is $50,001. So $50,000 is fine. It does not violate the definition of life insurance, but $50,001 is the limit. And you can see that the MEC limit is greater than the guideline level premium. So the premium in this case would be limited by the guideline level premium and not by the MEC limit. I'll also use this opportunity, as long as it's up on screen. The guideline single premium is the maximum single premium that you can put into a life insurance policy and still meet the definition of life insurance. Now, a policy designed with one single large premium like that is going to be a modified endowment contract. The fourth thing that you should look for on your policy illustration is that all the premiums are level, that there's no lump sums. And this is something that I covered in last week's video. This is an illustration for a policy that had a $36,000 lump sum premium payment, followed by $12,000 a year of level premium. And the problem here is that the policy costs are a function of the death benefit, and the death benefit is a function of the first year premium that goes into a policy. So even though the subsequent years are lower, the fees were set by the death benefit that was a function of that large premium the first year. So the costs in this policy that you're looking at right here are 3 times what they should be had the first year premium just been $12,000. So you can see that those costs are going to consume that additional premium that was put into that policy over the next 10 years. The fifth thing that you should be looking for, if you're using an indexed universal life, you want to make sure that the policy has an early cash value rider on it. And what the early cash value rider does is it eliminates the surrender charges on the policy. Meaning, if you surrender the policy, you'll get back all of the cash value that you have. Normally, policies have a surrender charge, which means that since the insurance company went to the expense of underwriting you, they're simply not going to give you back all of the money that you put into the policy if you cancel the contract. But the early cash value rider, in exchange for a fee, waives those charges so that you can access the cash value. The surrender value also sets the limit on how much money you can borrow against the policy, because otherwise you could simply borrow against the policy and then surrender it as an end run around the surrender charges. But that rider needs to be on the policy if you intend to leverage the cash values to invest in real estate. Otherwise, you're just not putting all of the money to work in 2 places at one time. So what we're looking at here is that the surrender value is exactly equal to the accumulation value. All right, the sixth thing that you should look for, again, this is only for an indexed universal life, not a whole life, is that the death benefit option is set to increasing, not level. A level death benefit option will not give you a maximum overfunded life insurance policy. And then the other change that needs to happen is that when the premiums cease, like if you're paying for 5 years and then you want the policy to be paid up, or 10 years, or if you just want to pay until you're age 65, whenever you decide to stop making premium payments into the policy, that's when the death benefit option should be switched to level, and the face value of the policy should be reduced to the minimum non-MEC amount. Now, I've used this graph in past presentations that I've done, and this is showing the death benefit relative to the cash value in a maximum overfunded life insurance policy, or a policy that's designed for minimum non-MEC death benefit. This particular policy was a 10-pay design based on $100,000. And again, the graph doesn't show whether it's indexed universal life or whole life. This would be applicable in either case. You can see that at the point where the client wants to stop making premium payments, 10 years into the policy, you can see the large reduction in the death benefit at that point. If this were a whole life design, the way that the death benefit is held high like that is by putting a term rider on the policy that allows for more paid up additions to be paid into the policy. And at the end of that 10-year period is when you'd want to drop that term rider and get rid of all the associated expenses with that rider. So here we're looking at an illustration that shows the reduction in the death benefit. This again is a 5-pay design on $100,000 a year. on a 32-year-old. And the initial death benefit was up over 4.2 million. And you can see that the death benefit is increasing each year through the 5th year when the client stops making the premium payments. Then we see a very substantial decrease in the death benefit in the cells that I've got highlighted in orange. So it looks like about a $2.5 million roughly drop in the death benefit. But more importantly, look at the relationship between the cash value and the death benefit. You can see that in the last year where the death benefit is high, there was about $4 million, over $4 million of total death benefit protection on top of the cash value. And that death benefit protection has a cost associated with it. It costs money to get a term policy for $4 million. But in the subsequent year, when the death benefit is reduced, you can see that the difference between the cash value and the death benefit is just over $1 million. So we've essentially driven out 2/3 of the cost by making that change in the death benefit from increasing to level, and the decrease in the face value from 4.6 million down to almost 2 million. So you might have heard of a 10-pay design. This is a way to get a paid up policy in the whole life world, a policy that's fully paid up at the end of 10 years. There are also products for 20 pays and pay to 65 in the whole life world. But all of these, what they represent is that you're getting a fully paid up policy at the end of 10 years, 20 years, or at age 65. And what paid up means is just that that's the point where the policy is fully paid up, and it will be maintaining a minimum non-MEC death benefit from that point on. 10 pays are overfunded policies, but they're not maximum overfunded life insurance policies. All right, so now we're going to talk about the growth rates that are in the policy. And these are up to you and the agent to work out what you want to have. So don't just take what the agent gives you as a given. It's up to you to determine what is a reasonable growth rate for the policy to use. And what we have to keep in mind is that in a whole life policy, the insurance company is investing their assets, your cash value, in safe, secured debt instruments. So the insurance company is buying tons of treasuries, they're buying tons of corporate bonds, and they're also buying mortgages off of the banks. All of these things generate interest payments, and that's where the growth and that's where your dividends come from. What they make in interest is what they pay in dividends. So if they're investing their assets in the bond markets, what are the bond markets earning? And a good proxy for the debt market or bond market rate of return is the Moody's Corporate Bond Index average. Right now, the Moody's Corporate Bond Index average is 2.73% for AA bonds. There are several companies out there right now that I know that are paying over a 6% dividend. If they're investing their assets in the bond markets, they're buying treasuries, they're buying mortgages, how in the world are they paying a 6% dividend? So let's give them the benefit of the doubt that they can pay 6%. But is 6% a reasonable number to use as a projection going forward for the rest of your life? Because this is a life insurance policy. It's going to be there for the rest of your life. Do you really think they're going to be able to continue paying 6% dividends every year in an interest rate climate where the top rated bonds are only paying 2.73%? So given that their portfolio represents a mix of highly rated and maybe lower rated bonds, I think a reasonable growth rate assumption for a whole life would be somewhere closer to 4, but in the 4s, no higher than 5. Now let's look at an index universal life. What's important to remember with an index universal life is that the goal is not to capture the equity market returns. The goal of an index universal life is to simply beat the debt market rate of return. If you put yourself in the position of the insurance company, the cash value again is you, or the policy owner, literally saving up the death benefit for the insured over the insured's lifetime. So the faster the cash value grows, the quicker the risk in the policy is eliminated. So the insurance companies have an incentive to grow that cash value as quickly as possible. And that's one of the reasons why Index Universal Life was developed in the first place, was they found a way that they could safely, while still protecting the principal, they found a way that they could capture some of the equity premium by using options to hedge the market indices. So basically what they're doing is they're simply taking the money that they're making off of those interest-bearing debt investments, and they're using that money, instead of paying it to you as a dividend, they're going to the options markets and they're hedging to basically buy as much movement in the market as they can capture with the money that they have to spend. And the problem in today's low interest rate climate is that they don't have a lot of money to spend. So what you're seeing is that the caps on index universal life products for all the different indices are going down. And it's not that the insurance company is trying to screw anybody, it's just that that's as much movement in the market as they could buy with the money that they have to spend. But we need to figure out what is a reasonable rate of return to use. When I do what's called a look back, I'm just applying the current cap to the historical market changes. I'm seeing annualized returns in the neighborhood of 6 on the low end, up to as high as 7 still. So anywhere in that range would be a reasonable projection. I tend to be conservative, so I use 6%. One thing you need to be wary of is when I say 6%, I would apply that to every indexing strategy out there. Again, there are going to be times when one index is going to do better than another. One is going to give you a 0 while another one actually has movement. But the goal is to not capture the market movement of that index. The goal is simply to beat the debt market rate of return that they would have otherwise had they not done any hedging. That's the interest rate that they would have paid out as a dividend or interest. Insurance companies are always coming out with new indices to track against and new indexing strategies. So one of the things that I worry about with all of these new interest crediting strategies is that they're coming up with ways of hedging that simply look good when you apply it to the historical rate of return. So they're actually coming up with strategies that they know will look good when you apply it to the last 30 years of history. But that past performance is not indicative of the future performance. So that's why I say 6% is a nice safe number, because if the S&P 500 is down 1 year, something else may be up. But just because a market index or an indexing strategy had an 8% historical return going back 30 years, doesn't mean that it's going to have that same return looking forward. All right, the ninth thing to look at. You know, when I first started this, I never expected to have the list be so long. I thought this would be a nice short video, but here we are. It's turning into a nice long video again. But the ninth thing to look for is saving age. So if you are within 6 months of your next birthday, typically the policy will use your next age as the starting age for the policy. But one thing you can do if you're trying to stuff your policy full of cash is save the age. So you can backdate the issue date of the policy to within 6 months of your last birthday. What that does is it means that is your new policy anniversary. So the next premium is due in a shorter than 12-month period. For somebody who's cost conscious, that would be a concern, because now they've got to pay for time that they didn't use, for one, and they've got to pay for the next year's premium before 12 months are up. But if your goal is to stuff as much cash into the policy as you can, it's actually a good thing, because now you can get cash into the policy sooner than waiting until the 12-month anniversary. All right, the 10th thing to look for is having a variable loan option that's available right away. So if you've watched any of my other videos, you know that I recommend that you use a cash value line of credit from a third-party financial institution to access your cash value. That way the interest on your loan becomes tax deductible, and it helps your overall business case. But there are times when taking a policy loan from the insurance company is the better way of doing it. One example for that might be to make a down payment on an investment property. You know, there might be a time when you don't want to let the lender know that you are utilizing a line of credit to make that down payment. You know, lenders like to see you have a little skin in the game. So taking a policy loan is a way to have the cash that you can make for the down payment. The interest may not be tax deductible for your investment, but you can make that investment nonetheless. So while we're on this subject, let's talk about fixed versus variable loans. Fixed loans may sound good because it sounds like the interest rate is fixed, like you would have on a 30-year fixed mortgage, for example. But when you're talking about policy loans, the fixed interest means that they're also taking the collateral that secures the loan, meaning your cash value, and they're moving that into the fixed interest crediting strategy. And typically, fixed policy loans are what we call wash loans, meaning the rate that they're paying on the policy is exactly equal to the rate that they're charging on the loan. And in fact, it gets even worse than that. Typically, during the first 10 years of the policy, the insurance companies will actually penalize you. So they'll charge you, let's just say 4%, while they're only crediting 3% to your policy. So you're actually taking 1% step backwards when you do that. So we need a policy where there's a variable loan option that's available right from the beginning of the policy. And the thing is that that's very rare. I think if you scan the universe of index universal life insurance policies, you'll find that there's very few that actually offer a variable loan option from the policy inception. So it's important to work with an agent who understands those companies and the need for that variable loan option. When you choose a variable loan option, the collateral remains in the indexing strategies that you selected. So you have an opportunity to still capture that equity premium on your cash value while you're paying a flat variable loan charge from the insurance company or for your line of credit. Now understand too, if you're taking a line of credit, this is all moot, but if you're borrowing against your policy's cash value, you need to have this option here. It's also important that the loan be non-direct recognition, which is also known as a participating loan, meaning that the insurance company understands that the cash value is collateral for the loan, so they still continue to pay interest credits to the cash value or dividends in the case of whole life. There are some insurance companies that do not do participating loans, and if you've got a loan outstanding, then they don't pay interest credits or dividends on the cash value that's actually securing that loan. All right, some things to consider. Number 11, if you're using your policy's cash value to leverage into real estate, you probably don't want the cost of any additional riders in there. There are any number of different riders that you can put on the policy. But again, if those riders are important to you, consider putting them onto either a separate term or a separate permanent life insurance policy. Only if you do it on a permanent life insurance policy, just make sure that it's a minimally funded life insurance policy. One other thing that a lot of indexed universal life insurance policies have are accelerated living benefits riders. These are riders that pay out a benefit if you become critically ill, meaning you have a heart attack, stroke, cancer, end-stage renal failure. Some companies pay out for as few as 6 different illnesses, but some have very large lists. They also include chronic care illness. So if you cannot perform 2 out of the 6 activities of daily living, then the policy will pay a portion of the death benefit in advance in monthly stipends for you. So that those are accelerated living benefits riders, basically meaning that the policy's death benefit or a portion thereof is paid out to you while you're alive, a living benefit. If you're using your policy's cash value to leverage into real estate, understand that any payment they make is coming from the cash value. You know, the cash value represents a portion of the death benefit. So if you've got your policy's cash value leveraged to the hilt, your ability to take advantage of these riders is going to be limited. So I recommend that if these riders are important to you, and they are valuable, that you put them onto a separate minimally funded permanent life insurance policy. Now, if we go back and look at the chart for that maximum overfunded life insurance policy where the death benefit was reduced when the client was stopping his premium payments after 10 years, during those first 10 years, there is still a substantial benefit to having that accelerated living benefit rider on the policy. But that benefit goes away immediately once the death benefit is reduced, because now most of the death benefit is the cash value of the policy. There's very little additional protection being offered by the insurance company. If you're considering a policy where you're young and paying till age 65, you're going to have that very large corridor of insurance all the way out to age 65 when you cease making premium payments. But again, after age 65, probably when you need it most, that's when that additional death benefit protection is going to go away. So again, if the accelerated living benefit riders are important, consider putting them into a separate dedicated policy just for that. So let's talk about some of the agent tricks, things that agents do to make the policy look good. The first and foremost is look at the growth rate assumptions. Make sure that they aren't overly aggressive. Again, to me, if you're using a whole life, the projected dividend rates should be 4 to 4.5, certainly no more than 5%. I just don't know where whole life companies are making or investing their cash that they can make over 4% in today's market. If it's an indexed universal life, based on current cap rates for the 1 year point to point on an S&P 500, I wouldn't illustrate any more than a 6% interest crediting rate. And I would use that 6% across all the different interest crediting strategies, regardless of what index they're tied to, just to be conservative. Another thing to consider, if you're getting illustrations on multiple products from different companies, make sure that all of the inputs are apples to apples. It primarily comes down to the growth rate on the interest crediting. Different companies have different rates that they use, so just make sure that they're all equal. You could have a policy that's illustrating a 7% growth rate look better than one that has lower internal costs, but is only showing a 6% growth rate. When the interest rates are all set to equal and all the input assumptions in the illustration are apples to apples, what you're going to see is the company whose illustration looks the best is probably the insurance company whose costs are the lowest. If the costs are lower, that leaves you with more cash. And you're still buying as much death benefit protection, which still meets the definition of life insurance. So make sure all the inputs are apples to apples across all the illustrations that you're running. If your illustration includes projections of retirement income, make sure that those projections run all the way out through age 120. One thing that I see all the time is, somebody will tell me, well, this company XYZ is showing that I can get, $85,000 a year income. But they're only showing it for 20 years, from age 65 to 85. What if you live a little bit longer than that? I think the more conservative way to go is to run the income projections out all the way through age 120. And really that has the added benefit of showing somebody just how powerful life insurance is as a retirement planning tool, because you can literally state that the policy will be able to generate income for as long as you live. And even if it's a few dollars lower, that's a powerful statement. The last thing is, a lot of insurance companies are offering new, what I call leveraged interest crediting strategies. So if we go back to how indexed universal life works, remember they're taking the interest that they earn in the bond markets and they're going over to the index options markets to hedge and try to capture as much movement in the market as they can get using options. Well, what if they had more money to spend? So some companies are offering an option where if in exchange for a fee, you can actually buy a higher cap on the index with more movement. And when these first came out, I thought they were kind of unique, and I thought actually were a good thing for myself, who understands how they work and the fact that they are to be used when you think you can time the market. Because if we assume that the market is going up and down, and sometimes there are years where it stays between the floor and the cap, well, if you're getting charged with a fee to get a higher cap, you only win in years where the market performance was greater than the cap. In years where the market went down, you took that fee and didn't get anything in return. In years where the return was between 0 and the original cap, you basically lost that money as well. So these only work when the market index change exceeds the cap rate. So it's very possible that people that don't understand what they're doing could have this strategy selected for them by the agent. And that fee can actually hamper the performance and burn cash value if the performance of the market if the market doesn't perform. The other caveat with those leverage strategies is that because they have a higher cap, they typically can illustrate a higher projected rate of growth, which gets back to my first point. Use a reasonable rate of return projection. And stay away from the leverage strategies just because they're not for the average person. If you understand how it works and when it's to be used, by all means take advantage of it. But for the average person, you don't need to have these leverage strategies in your cash value. So wrapping up, in conclusion, if life insurance isn't your job, then it's hard to have the knowledge that it takes to look at a life insurance illustration and know that you're getting a well-designed, maximum overfunded life insurance policy. So you're at the mercy of the agent that you're working with, that they understand life insurance, that they didn't just get their life insurance license last week, and not only do they have their license, but they understand how to design a maximum overfunded life insurance policy. This is not the way that most life insurance agents design policies. Life insurance agents get paid on death benefit. So the higher the death benefit, the more money they're making in commission. These policies are designed for minimum death benefit. So the policy commission is very low. It's minimized. So hopefully this presentation gave you some tips that you can use to look at any life insurance illustration that you review and know that you got the best policy design that you could. So with that, I'll wrap up. Thanks for watching. If you enjoyed this, please be sure to like and subscribe so that you're notified whenever I put out new videos. Please let me know in the comments if there are any subjects that you want me to cover, or if there's anything in this video that I glossed over that you'd like me to dive into in more detail in a future video. So if you're interested in any more information on the topics we've discussed today, please be sure to check out my website. I consider my website to be a no fluff zone, so everything that you find there should be educational. There's no selling. In addition, you can join the Facebook group called The Double Play, which is a community of like-minded real estate investors who are using their life insurance policies to invest in real estate. And even if you're a newbie, just go there, post questions. Most of the members are more than willing to help out. And with that, I'd like to thank you for watching.